Hello, everyone, and welcome back to another episode. My name is Jordan. I'm a millennial investor, and in today we're going to give my monthly update for how my portfolio did for the month of March. So, starting off, you can see that I do have my monthly updates here where I'm trying to reach my $1,000,000 goal by the age of 40. This is my birthday on my 40th birthday on my $1,000,000 number right here, and this is where I need to be at on an annual and a monthly basis over here on the right side. And you can see that we're falling short. We were doing very good just a couple months ago, and we've definitely come down quite significantly. And as of April 1st, today on the day that I'm filming this video, we finished out with $44,631, which you can see from my account right here. We're going to go over briefly, really quick, the positions that I have open. We're going to talk about positions that I've closed in 2023, the profits I've taken, and then also my performance tracked year to date versus the major indexes, as well as my holdings tab, my performance, and all that good stuff. So it's going to be a fun one. Without further ado, if you haven't seen me before, my name is Jordan. I'm a millennial investor. And one of the easiest ways for me to share my description and share my portfolio down below is to use M1 Finance. It's a free service that allows you to get up to $100 for signing up, and you'd help support me and my channel, so check that out down below, like the 134 people that have signed up so far. So without further ado, let's go ahead and dive straight into my portfolio, sorted from largest to smallest, and see what I've got so far. So starting off, we have Dropbox, my largest position, currently sitting at a little over $32,000 in position size. If we hop over here to my handy dandy software, you can see that Dropbox is currently still a company that is growing in terms of its top line revenue and its bottom line profitability. You can see that this is one. Let's actually pull up the stock price here before I show these metrics. One of the reasons why I'm so bullish on this company is because you look, it just hit its 5-year anniversary for being public. It went public around late March of 2018, so it has now officially been public 5 years long now, and that was initially going public just under $30 a share. Now, what has happened since the first quarter of 2018, 5 years ago? Well, let's look at the revenue. Back in the first quarter of 2018, they were doing around $316 million in revenue. Now, if you fast forward to today, they went from 316 up to about 600 million in revenue. Pretty much a double up. Same thing can be said about free cash flow. If you look at their 2018 free cash flow versus the last year's free cash flow, in 2018 they were doing 359 million. Last year they did 762 million, and that's still projected to grow. What's even more impressive is that's just free cash flow. That does not factor in free cash flow per share, which if we look right here has grown even more. They did exactly $1 in 2018. Last year they did $2.11. So over a double up in terms of their free cash flow per share. And the reason that that one's higher than the actual free cash flow itself is because this company's been buying back a significant amount of its shares outstanding. Let's go ahead and look and see where the company was at in terms of its shares outstanding at the beginning of 2018. It was around 401 million, and now in the most recent quarter they're at 352 million. They bought back around 50 million of their 400 shares since they initially went public 5 years ago, which is a pretty substantial difference. It's around, what is that, around 12.5% just since this company went public. Now, in the meantime, they've also continually raised their cash pile. Now, I know that they did raise some debt late in 2021, but generally speaking, this has been a free cash flow generative company, and it's one that's having financial metrics go in the right direction. Their gross margins are generally going up. Their operating margins going up. Profit margins generally going up. And one of the things that's most interesting about this company is that if we look at this on an annual basis and we look at their actual expenses year over year, what's crazy is that if you look at their sales and marketing, the company has continually gone up in revenue, and their sales and marketing has actually gone down. Initially back in 2018, it was 439 million, and now it's down to 409. It's actually decreased despite the revenue going up. What about general and administrative? They have been lowering the amount that they're paying employees, meaning they're probably cutting down on their employee base every single year since 2018, paying less and less. And you know they're not having to pay a lot of stock-based compensation because the stock has done so poorly over the last 5 years. The one thing that has gone up is R&D, and that's mostly because they're coming out with new products. And one thing I'll mention about this R&D, I don't think it's completely unnecessary or completely out of whack. 768 up to 891. That's not a huge jump over a 4-year period. That's pretty reasonable in my opinion, especially for a big tech company. So when I show you all these metrics of this company going in the right direction, what's most important here and most shocking is the fact that basically this company was trading initially public around $30, around 28 or so to be exact. And today, the company, despite having higher revenue, higher profitability, all these awesome metrics, Right now, Dropbox trades at $21, which is significantly less than that of where it was 5 years ago, and the free cash flow yield is now in the double digits. The company is projecting to have around $840 million in free cash flow this year, which is a far cry from last year's 762. So profits are still going in the correct direction. It's one that I think will continue to do good. And the cool part is that with this company buying back so much of the company stock, in fact, just in the last quarter, they bought back 7.37% year over year, which meaning that's equivalent to saying you're getting like a 7% dividend in a way. You're getting 7% ownership increase in your stake just for holding the company just over the last year. And that is pretty impressive, and I expect that to increase with this company's stock price staying low. So every day that goes by, when we have this company in the teens, in the low 20s, $25 a share range, as long as it stays around these prices, the company can continue to buy back tons and tons of shares. To get an annual buyback, which is the equivalent of almost like a dividend, getting an increase in ownership of your holding of 7% or more a year is absolutely incredible, which is almost like the average of the market. And that's assuming this company never grows revenue, which so far, over the last 5 years of being public, they've proven that they've been able to do that so far. I think they'll continue to grow top and bottom line, but in the meantime, as long as the company's share price stays remotely in the ballpark of where it's at now, this company could probably buy back somewhere between 5 and 10% of its company's shares back every single year while you hold it, which is pretty awesome in my opinion. And then of course I'm selling back covered calls all the time. I have been moving these around and taking profits on some, which you can see on this monthly chart right here for 2023, but I'm always selling covered calls in my main position, which takes me to my next main position, which is Amazon. Amazon so far this year has done pretty decent. I wouldn't say it's done amazing, but it has kept up pretty reasonable with the market. And before we go over Amazon, something I do want to mention is performance really quick. Performance so far this year, I am beating the S&P, but I am losing to the NASDAQ and these other indexes. So it is one I'm mostly focused on the S&P. For example, last year we had significantly better performance than the NASDAQ, which is in green, but I didn't really care about that because I wanted to beat the blue S&P, which is why I put it right next to it. And unfortunately, we fell just shy of it. So far this year, we're doing significantly better. We're about double that of the S&P, a little over double. So that's really want to focus on beating. But more importantly, beyond just the performance of the major indexes, I want to focus on this $1 million goal. So as of next month, I need to be at about 50 grand. So I've got a little bit of work to do. Now going to Amazon here, if we load up Qualtrim and we search up AMZN, which is Amazon's ticker, you can see that this company is one of the largest revenue companies in terms of revenue in the world. I think other than Walmart, they do more revenue than anybody. In 2022, they finished out with an astounding $513 billion in revenue, over $500 billion in revenue. Now, the reason that Amazon share prices went down so far is because of the negative free cash flow that they've been experiencing, because they were on the right track. They were growing in the right direction. They went from around 7 to 10 billion, and then 2018 they jumped up to 17. The year after they jumped up to 21, year after to 25, and it looked like we were going in the right direction. And then we had a massive free fall in terms of the free cash flow, not only going out of the positive and going down, but falling all the way to the negative, tens of billions of dollars. But I do want to let you know recently, as in the most recent quarters, we're starting to see a recovery. When you look at it on a quarter-over-quarter basis, this paints a different picture. Because when you see their original highs back in 2018, 2019, and 2020, this company was producing around 12 to 15 billion in free cash flow per quarter. And then last quarter, they gained back almost all that, doing 12.5 billion, showing that it's going right back in the right direction. Now that they're doing employee layoffs, they're reinvesting back in themselves, which is definitely something Amazon has always done since they've been founded. I think in terms of the free cash flow, this may not look like a perfect, beautiful upward chart because there may still be some inflation concerns, some layoffs, maybe some one-time costs associated with that. But generally speaking, I think we're going to get back to all-time highs. When you see this number right here of 25 billion in free cash flow, while I know it may seem like a far cry now, I think within the next couple of years, maybe 1 to 3 years, we'll eventually see Amazon doing 40, 50, 60 billion in free cash flow just a couple years from now, and I think it's safe to say that that will definitely help the stock price, and more importantly, it'll help the actual fundamentals of the business as we can get this decreasing cash pile back up, because ever since around 2021 it's been decreasing, and they've been using a lot of their cash to buy out other warehouses, other products, research and development, capex, because you can see pretty much their capex spending has basically exploded over the last couple years, doing now around 16 billion a quarter. Another thing that, speaking of which, this is a complete opposite of Dropbox. We were talking about buying back shares. Amazon does not do that. They basically dilute you as a shareholder essentially every single quarter. The dilution is very small, only 0.3% year over year, but it is something to factor in. Amazon one, by the way, I'll pull this up because Amazon is one that I really think is beneficial, mostly by owning AWS. That's really the big winner here. And when I look at my long-term projections and I look at all my notes here and everything that I think is important in terms of the company, what's really cool is looking at the growth of AWS and the success it's having. Despite its revenue growth slowing down significantly, and I am concerned of that, they're still doing around 20% growth year over year, which is still phenomenal. The quarter over quarter growth is just incredible. It is so profitable, and I expect the margins, which right now AWS is doing around 30% margins year over year. Last year they did 28.5. I think we'll get to a point where AWS starts to do 35, 40, 45% margins over the next decade. So that's why I want to be owning a company like Amazon. And next, that goes to my next position, which is Nvidia, which is brand new. I actually haven't updated my holdings percentage, but this is going to be a very short-term hold. I am doing very poorly on this so far, but basically, long story short, what I think, when I look at Nvidia, I think it's a very hype-driven, very story-driven play, because it's one that currently sits at around 700 billion in market cap, and last year's free cash flow was 3 billion. When we were looking at Dropbox earlier, this was one that had a free cash flow yield around 10%. This one has about a 0.5. Its next year forward PE ratio is around a 40. Its price to sales is a 14. A 14 price to sales. That is so incredibly high. And actually that may not even be correct. That it actually may be higher than that, because last year they did 27. Let me pull out my calculator here. 692 divided by 27. Okay, that looks actually about a 25 price. The point is, this thing is sky high. It's absolutely rocketed up higher. And don't get me wrong, while the quarterly revenue growth has been phenomenal over the last several years, you see that year over year they've actually shrunk revenue 20%. It doesn't make sense to me. The metrics do not make sense to me, in my opinion, on this company. They're burning through their cash very fast. They've went from around 21 billion a year ago. Now they're down to 13 billion. So they put off a pretty considerable chunk of that cash pile. And while they've done that, they've also increased their debt over the last couple of years, and they've only bought back a fraction of shares outstanding. We're talking about Dropbox buying around 7 to 8% of their company every year. This company bought back 1.6%, and they had to deplete a large part of their cash position just to do it. So long story short, between the incredibly high metrics, between them burning a lot of their cash pile, the shrinking revenue growth, or pretty much no revenue growth at all, if we look over the last year, what does it look like? A massive recovery from a bottom out around 6 months ago, around 115, 110. Now the company trades in the high 200s, almost $300 a share. If you look at a 2-year chart, it becomes more apparent how incredible the recovery has been, because since the peak in 2021 with a downturn, it's went lower and lower. Ever since around October, it's went around the low 100 range to almost $300. The sucker is going basically vertical for around 6 months straight now. I think that this run will likely come to an end soon. I'm not saying that Nvidia is going to be one that's going to go down to $50 a share or anything like that. The company, since I have some bit risky put options, if the company were to go down even 10, 20, 30%, I would likely do very well. And these put options go out all the way to September. Something else I want to add, with me being pretty levered and having a lot of long positions like Dropbox and Amazon, this is a wonderful hedge, because if the market continues to go up, Dropbox and Amazon will continue to do phenomenal, more than likely, assuming they're following the market going up. And if they go down, I think that it will definitely produce some ample cash in a time of need, like Nvidia, because if the market were to tank, I think it's very likely that Nvidia would tank right beside it. And not only if the market were to go down, say 10%, 15%. I don't think Nvidia would go down 10 or 15 right beside it. It would likely go down 20, 25, 30%, and would likely give me some ample returns and some extra cash moving forward. Now, iRobot, I've made a whole dedicated little spill to this before, so I don't want to go into in depth with this, but basically I'm betting on the arbitrage bet that the deal between Amazon and iRobot will be done by June 16th, around 2.5 months from now. Maybe I'm wrong, that could be completely off, and I'm willing to risk this $9,500. It could very well go to zero. There's a reasonable chance it will go to zero. If it were to go through, it would make tens of thousands of dollars and definitely put me forward in a big way. So I'm praying that between now and June 16th, it does come out positive news and does get approved by the FTC and other regulators that are looking at it. But it's one that I think is an interesting play. It's a bit of a gamble, one of the riskier plays I've ever done. And if it lose money, that's okay. I'll probably still hit my $1 million goals. And if it goes through, that will set me so far ahead, just so insanely far ahead. But these are the positions I currently have right now in my growth portfolio. I'm pretty happy with the performance. I can't complain. It could have been better, but it definitely could have been worse. So in the meantime, I'll keep updating you guys every single month. Get signed up with M1 Finance if you haven't already. But other than that, guys, thank you so much, and I'll catch you all next time.